Good morning, everyone. Welcome to the Cámara Peruana de Comercio Exterior, and welcome to our lectures, our weekly English lectures. Today, first of all, I hope you have a great weekend, and I also hope everybody is healthy. Please remember to follow all the necessary measures to stay safe when you go out. Wash your hands, wear your masks, okay, and just take all the necessary precautions to stay healthy. Today we're going to talk about and continuing with the topic of a specific business English, English for specific purposes. In this case, we're going to talk about financial markets. Well, this is not going to be a class of economy, or it's not going to be either to teach you what everything in like stock markets and stuff is, but just to give you basically concepts, definitions, um, um, definitions of certain words in English, okay, and their meaning in Spanish, okay. So let's begin. As always, my name is Carlos Martinez. I am an English instructor and speaking coach. I am a former team leader at Pacifico University, and currently I am an EFL teacher at Mater Purísima School in Miraflores. Okay, remember that I will follow your questions or try to answer your questions in in Zoom and also in Facebook. Remember that sometimes Facebook, your questions are received a little bit with a little delay, but I will try to answer them as quickly as possible. Okay, so I'm always following you also. So let's begin. Today we're going to talk about stock markets. As we have mentioned before, a stock is like a piece of a company. A company is divided into a certain amount of small portions, which a certain value. And if the company's value goes up, then your stock value goes up, which also means that you have a profit. But on the contrary, if the company value goes down, then your stock value goes down and you might lose money. And how much money you gain or how much money you lose will depend on the amount of stock that you own. So today we're going to talk about basically these three main topics: the stock index. We're going to try to define stock index and give examples of some of the stock markets that exist around the world. Then we're going to talk about what it means to own a stock. And finally, a very quick mention of how to value stocks. Okay, very good. Let's begin. Stock index. Okay, as its name says, a stock index or a stock market index is an index that measures a stock market, of course, or a subset of the stock market. It helps investors compare current price levels with past prices to calculate market performance. It is computed from the prices of selected stocks. So this is like to get, imagine this like a survey. You study the market, how it is currently and how it was in the past. And that way you can get an estimate of if maybe it's going to continue to go up or continue to go down. This is like statistics, it will help you know if certain stocks are gaining price or losing price, or maybe predict if they're going to lose or gain price. In that way, it can tell you if the market is healthy. I mean, if the market's going up, or if it's lost, like it sometimes happens. For example, nowadays, the stock index in the USA is very volatile now because of the elections. Sometimes, depending on what happens politically, and even in Peru, because we also have a stock market here. If politically everything is fine, normally the stock market tends to go up. But when there are these signs of instability, the stock market tends to go down. Okay? And that means that the index tends to go down, and this means that companies start to lose money, as well as the owners of the stocks. Now let's define some words related to the stock index. First, the definition of stock market, equity market, or share market. Okay, Now, this is the aggregation of buyers and sellers of stocks. Some people call them stocks, some people call them shares. It's the same thing, which represent ownership claims on businesses. Okay, like I was saying, um, if you own a stock, then you own, depending on how much stock you have and depending on how many parts the company is divided into, you own a certain piece of the business. Okay, so the aggregation or the conjunction or the unity of many buyers and sellers of the stocks, and which represent the ownership and claims of businesses. That is the stock market. Like any market, you buy and you sell. Next, what is a stock? Also called capital stock. Are all the shares into which ownership of a corporation is divided. So let's say you want to divide the company into 100 pieces, 100 small parts, then you have 100 stocks. And the more stocks you own, the more profit you will have or loss, depending on the value of the company, and of course how much you own of the company. If you own more than 50 or 60%, then practically you are the owner of the company, right? Also known as a stock, a single share of the stock represents the fractional ownership of the corporation in proportion of the total number of shares. So that means that if you own, if the company is divided into 100 pieces and you own only one, then you own 1% of the company, right? If it's only divided into 1,000 pieces, then you own 0.1%, and so on. Okay, so the more that you own, the more percentage, the more shares that you own, the more percentage of pieces of the company that you might own. This entitles a stockholder to a fraction of the company's earnings. So that means that, for example, if you own 1%, then you're going to be accredited 1% of all the profit that the company might have on the value. The same will happen in the losses. So this in the stock market, the more shares you own will depend on your profit or your loss. If you own a lot and the company is valued or gains more value, your profit will be bigger. The same will happen if you own a lot of stocks and for some reason the company is devalued or loses its value in the stock market, then you will lose money proportionally to the amount of shares that you own. Equity crowdfunding. It is the online offering of private company securities to a group of people for investment. Okay, this is, remember, equity crowdfunding is the online offering of private company securities. Now, what is a security? A security is a fungible and tradable financial instrument used to raise capital in public and private markets. Okay, so understand that it's like something that allows you to say, uh, uh, for example, I have this money, I'm going to buy a stock, then I know my money is not lost. Okay, it's like an insurance. That's a security. It's fungible and tradable. Fungible means that you have the ability to change it. Okay, if something is fungible, you can change it for something of the same value. Okay, talking about securities, there are three types of securities. The first one is an equity, which means that it gives you the right. You have rights to of profit. Then you have also another security could be a debt. It's money that you give in exchange for small periodic payments. Monthly or weekly. And finally, a hybrid, which is a combination of an equity and a debt. Okay, so that's when I talk about securities. Okay, let's continue. Here are some more definitions. Another definition that is used in the financial market is a fund. A fund is a pool of money that is allocated for specific purposes. Okay, that means that we use it for specifically this. Okay, a fund cannot be used for anything. Normally funds are specific. Okay, a fund can be established for any purpose whatsoever. Okay, I can establish a fund to invest in real estate, to invest in education, to invest in health. You decide. Okay, and a pool is like a recollection. You gather money. That is the general meaning of a fund. Now we have a mutual fund. A mutual fund is an open-end, professionally managed investment fund. Okay, that pools money for many investors to purchase securities. So a mutual fund is that, okay, me and a group of people or companies, we're going to get together and we're going to put all our money together, and with this we're going we're going to buy or purchase securities, stocks or bonds or whatever. Mutual funds are the largest proportion of equity of the US corporations, okay? Very good. Then we have an investment fund, a way of investing money alongside other investors in order to benefit from the inherent advantages of working as part of a group, such as reducing the risks of the investment by a significant percentage. What does this mean? That, for example, okay, the first one is I want to invest in, let's say, building something, okay, but it's going to cost me 1,000 or whatever. If I can get together with 10 more people, in then we're going to continue to invest this 1,000. But now, if I get together with 10, we're only going to divide the 1,000 amongst the 10. So in case there is a risk, then I'm not going to lose 1,000. I'm only going to lose my proportion. Okay, I'm only going to lose my proportion. So it reduces the risk. It reduces the risk because I get together with other people to invest in again in whatever we please. Okay. So this is an investment fund. Okay, when we get together with people to invest and to reduce the risk. Then we have open-end fund and closed-end fund. An open-end fund is a collective investment scheme that can issue and redeem shares at any time. That means that it's like creating shares. I need 10, here's 10. I need 20, here's 20. There is no limit on the amount of shares that I can create. An investor will generally purchase shares in the fund directly from the fund itself rather than from the existing shareholder. So I don't need to, the fund, the number of shares that it has is, I'm not going to say infinite, but I mean, if I want to just go buy in this and buy in this fund or acquire from this fund as many shares that I want, but it's also, I can buy and sell, I can buy and sell, I can buy and sell. Okay. So it's like, it always has a balance. It sells stock, it sells shares, and it buys shares, okay, from people. A closed-end fund is similar only to the end of where the number of stocks or shares that I have is limited. It's not like the open-end fund. For example, I can set up a fixed number of shares that I want to sell. Okay, and also I only sell. I cannot buy. It's not like open-end fund where I can buy and sell. I can give money for the value of shares, and I can also sell shares for a certain value. In closed-end fund, no, I only sell the shares or give the shares. Okay, a collective investment model based on issuing a fixed number. A fixed number, that means that it's not unlimited like open-end fund, which are not redeemable. That means that I can sell the shares, but you cannot sell them back to me. In open-end fund, yes, okay, I can sell the shares, and if you want to sell your shares, I can buy them at a certain price. So it's like a give and take situation. Where in closed-end, no. Unlike open-end funds, new shares in closed-end funds are not created by managers to meet demands for investors. Okay, so the managers, if an investor needs 100 in an open-end fund, the manager says, okay, here's your 100. If I need 1,000, okay, here's your 1,000. No, in the closed-end fund, this is what I have and this is what I have. Instead, the shares can be purchased and sold only in the market. Okay, so if you want to buy, I can sell you the shares, but then if you want to negotiate them, then you need to go to the stock market to do this. Whereas an open-end fund, no. In the open-end fund, I don't need to go to the stock market. I can just do my negotiation with the fund. Okay, so these are some definitions related to again the financial market. This is basically how it's going to go in this lecture. Very well. Remember that if you have any questions, I can, again, I follow you on Facebook and also here in Zoom. Now, different stock indexes. Okay, around the world, there are many different ones. For example, we have the Standard & Poor's 500, which is the index of the 500 large companies in the US, and this is the S&P 500. Then we have the NASDAQ. The NASDAQ is the index of 4,000 US companies, many of them in the technological area, but there are also others like Starbucks and all these other profitable companies. And these are, but basically there are many of the technological companies are in the NASDAQ. Okay, but it's an index of the 4,000 US companies. Okay. Then another index that we have is the Dow. The Dow is the index of 30 large, well-established US companies that are chosen by the Wall Street Journal. Okay, this is the Dow. So again, so notice when you talk about Wall Street, you always hear NASDAQ and Dow. Well, the NASDAQ again is the index or the like I said, or the number or the standard, okay, or the like I said before, it's the measure of how these companies are going. Are they healthy? They're going up. They're unhealthy. They're going down. It depends on the price, right? So again, Nasdaq is the index of 4,000 U.S. companies, many of them in the technology area. The Dow is the index of 30 large companies, but they are chosen by Wall Street Journal. And the S&P 500 is the index of 500 large U.S. companies. This is in the US, but we also have international, like for example, the DAX. The DAX is the index of 30 large German companies. Okay, then we have the FTSE, which is the index of 100 large UK companies. And finally, we have the CAC, which is the index of 40 large French companies. Okay, so these are 6 of the major stock indexes around the world. But some of them some that are not here are, for example, from the Japanese market, which in Japan, the Asian market. In Japan, it's called the Nikkei. For example, in China, it's called the SSE, which is the Shanghai Stock Exchange, SSE. And another one that is important is the South Korean one, which is the KRX, which is the Korean Exchange. Okay, so these are some of the most important stock indexes around the world, in the US, in Europe, and in Asia. Here in Lima, we also have one. It's the Bolsa Valores de Lima. Okay, but these are the ones that generate or negotiate the most amount of shares and of course money. Okay, some people they think what does it mean to own stock? Okay, why should I buy stock? I mean, why does everybody buy stock? Is it something that I want to do? I mean, I don't know. First of all, you need capital, definitely, because again, like I said, a stock the stock value depends on the company that you want to buy. And the stock value of a share from Apple is not going to be the same as the stock value of a share from, let's say, talking about technology, let's say Nokia, for example. Even though Nokia is still big, but the value of the share is definitely going to be bigger in Apple because it's more profitable, it's more valuable. And then comes the amount of shares that you want to buy. If you want to own one or if you want to own 1,000, okay? So this totally depends on, first of all, what capital you have. Second, the degree of risk that you want to take, because like I said, yes, if you have more stock and more shares and the company is more valuable every day, then you gain money. But also if for some reason the company falls, or the stock market in general, the index, which is the standardized value of market falls, then you're going to lose money. So it's a risk. It's a risk. And your profit can be a lot, or your loss can be a lot. So definitely stock markets are always a risk. So let's, what does this mean? Most people realize that owning stock means buying a percentage of ownership of the company. So again, it's a percentage. And it all depends on how many stocks the company has. Again, I'm going to give you the example. If the company is divided into 100, then when you own one, then you own 1%. If the company is divided into 1,000 and you own one, then your value is 0.1%. Okay, so it depends. It totally depends. Your profits and your gains are going to depend on the percentage that you have. But many new investors have misconceptions about the benefits and responsibilities of being a shareholder. A misconception is when you think you know what the meaning is, but you have the wrong interpretation. Okay, that's a misconception. So I'm going to give you 3 important misconceptions. The first one is that okay, because I own stock, I am your boss. If I own a stock from Apple company, that doesn't mean that I am the boss of the employees or no. First of all, I mean, I only own one piece of the share. Okay, I would need to own maybe more than half of the stock to consider myself to have a certain or a strong control of the company. But still, even though as the owner of a common stock, you get a bit of a say in controlling the shape and direction of the company, even though this say does not represent direct control. Definitely, the control depends on the CEO, the CFO, or the CEO of the company, not on you. You own only a share of the profits and the losses. So that's the first misconception. Okay, you're the boss of nobody, um, just because you own share. Misconception number two: you get discounts of goods and services. For example, okay, I own shares of Apple, so I can go and buy. Okay, and I go into an Apple store and I want to buy a laptop, or I want to buy a tablet. Oh, I own a share, so give me a discount. No, the only thing you get with ownership is the ability to participate in the company's profitability and losses. Okay, that's the only thing you get. Okay, that doesn't mean because you have a share of a coffee company you can drink free coffee. No, or because you have shares of an automobile company you can get discounts at buying a car. No, this only means that you share in the profits and in the losses. That's all. That's all that it means. And a third misconception is that I own the chair, the desk, the pen. Okay, that means that you own the property, that you own the things. Again, as an investor in the company, you own a portion of the company, a portion. Okay, 0.001 or maybe 50% or 80%, but it's only a portion. However, this does not mean that you own property of the company. Okay, one thing is you to own profits. Okay, if this company is profitable and it makes a lot of money, then I will share this profit. If it loses money, I will share this loss, but I don't own the actual property, the building, the chairs, the computers. No, that belongs to the company. That doesn't belong to the shareholders. Okay, the shareholders only own profits or losses. Okay, so this is what, like I said before, sometimes people think that, okay, I'm going to invest and then I own the company or I am boss of the people, or this is not, that doesn't happen. Okay, when you own a stock, you share the profits or the losses of a company. And of course, it totally depends on how many stocks or shares you own. And that depends on the capital that you have and where you're investing. Very good. So this is what ownership of stock means. Let's continue. Stock valuation. Now, how do we evaluate stock? Okay, how do we know how much something is worth? There are many ways. One way is, for example, with the PE ratio. That means the price of the stock versus its earnings. Okay, so that you can value something. Okay, if this costs 10 and the earnings are 100, I divide it. There's a mathematical formula to get it, and the result is the PE ratio. Okay. Oh, if it's normally there's a standard ratio for each company. Okay, let's say I'm going to give you a number. If the standard ratio is 10, if it's above, then you are gaining money. If it's below, then you're losing money, right? So the stock valuation is an important tool that can help you make informed decisions about trading. Okay, do I want to buy? Do I want to sell? How much do I want to buy? How much do I want to sell? When can I buy or when can I sell? Okay, it is a technique that determines the value of the company's stock by using standard formulas. Like I said, it's basically mathematics. It values the fair market value of a financial instrument at a particular time. Okay, so it tells you, okay, and this value changes day to day, hour by hour. Okay, a stock can begin the day with a certain value and can finish the day with double the value or double the loss. It depends on the market. It depends on what's happening. It can be one day soaring up high and the next day crashing. Stock valuation is totally volatile, depending on many things, depending on politics, depending on, let's say, the environment. It depends on the economy of the country. There are many things that affect the valuation of the stock. But like I said, it's very volatile. Okay, so again, it values the fair market value of a financial instrument at a particular time. The reason for stock valuation is to predict the future price or potential market prices for the investors to time their sales or purchase the investment. So if I want to know when to buy and when to sell, I need to know the stock valuation. Okay, again, I am not to go into too much, into too much detail regarding on how to value the stocks, but I'm going to give you some general idea of what can cause stock valuation. Okay, so again, like the question is, why do stocks go up and down in price? And when should I buy? When should I sell? There are three tools that companies usually use, not to go specifically into the formulas. Okay, the first one is the analysis of individual companies. Okay, so I analyze the company. What is their position? What is the performance? How are they doing? Like I said, it's the statistics of the company. Does it normally go up? If I go into a company and I see that every week, every year, I mean, it's always losing money, I would have to have, I don't know what type of information for me to go and buy that stock. On the contrary, if I see that a company is always going up, 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 I can have the idea that I'm going to win money. Okay, so I analyze each individual company. Second, I analyze the national and global economy. Okay, for example, if I want to invest in a company from, let's say, Peru, okay, how is the Peruvian economy? How is the Peruvian politics? Okay, is this a company that's going to continue to grow, or is maybe there are some political issues that might happen? You know, you think about the future. It's like playing chess. You predict your moves, what's going to happen then and then and then. Okay, so you have to analyze the national and global economy of where you are at and where the company is from. If you are going to invest in the NYSE, in the New York Stock Exchange, okay, but the company is from, let's say, India or Brazil, I need to evaluate how is the economy of India and Brazil, because that company, even though it is in the New York Stock Exchange, it's still dependent on its national government, okay, and its policies. Okay, so it's also good to analyze this. And finally, the technical analysis. Here is where the mathematics and the formulas come in, right? Charts, statistics, to identify trends, if it's going up. I mean, through formulas and evaluation statistics, I can predict. You know, I take measurements from the different months and the different years, and I can say, okay, normally this company in June, normally it goes up, normally it falls in December, or at the beginning of the year is the best time to buy, at the end of the year is the worst time to sell. It's all based on statistics and analysis. Okay, it evaluates volume, you know, the quantity, and also momentum. Momentum is the rate of acceleration. Okay, how fast it grows sometimes. Okay, so all these things are necessary to be studied or evaluated. Okay, all these things are I think, yes, yeah, I mean, yeah, because people sometimes don't. I mean, sometimes we think stocks, and when we think of the stock market, we think of the movies with the stockbrokers, you know, and or with the suits and with the money, and maybe they make the money because they get paid whether or not you lose or not. But if you own the stocks, then you can't afford to lose money, or you don't own things. Okay, remember, you only own the profit or the losses. Okay, so let's continue. So these are three ways of evaluating a stock. You evaluate the company itself and its history. You evaluate where it's from, where it's located, or where is the market, where is the stock going to be sold or bought. And finally, the technical analysis, which is done through statistics and charts and formulas. Okay, to predict what's going to happen and what could happen. I mean, what is going to happen and what could happen, because this is all prediction. We never know, and we can maybe invest. It reminds me of the prices of oil. I remember the day when a barrel of oil was over $100, and fuels and gas prices were all, you know, over the roof. And nowadays with COVID, I remember one day I saw in the stock market the value of the oil barrel was minus I don't know how many dollars. Okay, so you can imagine how volatile it can be depending on the. And here there was no political problem, there was no environmental problem like a tsunami or a hurricane or a tornado, nothing. it was a health issue that affected the whole world. So these things tend to be very volatile. Okay, so and like I mentioned before, here we said company analysis, analysis of the national and global economy, and technical analysis. So let's go into that with each one. Company analysis. Okay, when we talk about company analysis, we talk about the performance of the company, the growth of the company, how profitable it is, how much, what is its cash flow, how much debt it has. Okay. Next, we have the financial indicators. I mean, the earnings growth, the PE ratio that I mentioned before. The PE ratio is the ratio between price and earnings, the market capitalization. You know, how much capital it has in the market and stuff. So this is the first analysis that we do for the company, the performance. We also analyze the general economy, and this is about where the place where the shares are going to be sold or bought, and also the place where the company is located at. Excuse me. So we evaluate the growth and the productivity of the economy. Okay, is it growing? Is it producing? Is it does it have indexes that show that the company or the country is going to grow, or maybe there are indexes that the country is going to, it's not going to grow, but maybe it's going to reduce its in size. The inflation and direction of the interest rates. Okay, this is very important. If you know that the country has inflation that is too large, for example, 3 or 4 or 5% is a normal inflation. It's not good, but it's normal. Whereas here in Peru, when we were in the 80s with the 2000 inflation, why would you invest with a company from this country when you know that its value is going to change day by day, or it's basically nothing? The direction of the interest rates, you know, this is set by the company, by the country. Each country decides on what the interest rates is going to be, and then apply to everything. Find the financial, the business, everything is affected by the interest rates that the countries establish. Second, the consumer confidence, the willingness of consumer to spend. Okay, how confident are people on buying your product? Okay, how confident are your consumers or your customers willing to pay what you ask for? Okay, these things need to be evaluated to set a value. All these things are taken into account, and of course, they need to be studied and evaluated before you decide, first of all, on what the value of the stock is going to be. Second, if you buy or you sell. I mean, it's not, okay, everybody's buying, so let's buy. Everybody's selling, so let's sell. Or no, there's going to be a problem, there's going to be a problem, so the stocks are going to go down. It doesn't work that way, because if it were so easy, then everybody will be investing in the stock market and everybody will be making money. And it's not like that, okay? Many things need to be taken into account. Going back to company analysis, we talk about market position, okay? Here we have some things that we need to take into account. First of all is the barriers to entry. How difficult it is for new players to enter the market, okay? And this also indicates if it's too difficult, then that means that these shares are really, I mean, trendy and profitable because everybody wants a piece. Okay, so this can indicate something. The price elasticity, to what extent a rise in prices causes a fall in sales. So you have to know, okay, due to inflation or due to interest rates, maybe like we mentioned before, a price may need to go up. How can this affect the price of your stock or your situation? Okay, to what extent a rise in price causes the fall in sales? So if I elevate my price, does that mean that my sales are going to diminish? For example, again, cell phones. Cell phones get more expensive day by day. Cell phones now can cost over $1,000, but there is no indication of a reduction in sales. Maybe a little bit, but still, people continue to buy cell phones. People continue to acquire the newest and the latest cell phone, independently on what the price is. So cell phones have a very, have a very high price elasticity. Their sales are rarely affected by the increase in price. The ease of substitution. To what extent customers can find similar products from other suppliers? Now, again, cell phones. Let's say, if I raise my price, do you think that people are going to go to another company and substitute mine and get the same quality or the same product. Okay, how easy is it for people to substitute my product, my whatever I am selling or whatever service I am giving? So if it's too easy, then that means that my value is not going to be very high. If it's difficult, then that means that my value is going to go up. Okay, because if it's difficult for a person to find something equal to me, then they're going to stay to me. It doesn't matter if I'm expensive, it doesn't matter. They're going to continue with me because they cannot find anything that will substitute me. But if they can find something that is equal to me or better, then they'll just go away. And of course, my value will go down. Then we have capital requirements and market penetration. This is how popular you are in the market, how far, how deep you are in society and in the country and things like that, how popular you are. That's market penetration. Okay. For example, certain cell phones have a better market penetration in certain areas. Others don't. Okay. How popular they are with the consumers and stuff like that. Okay. Then the next and final one is the technical analysis. Here, like I said, is statistics and formulas. The internal market factors such as volume, breadth, momentum. Like I said, volume is quantity. Breadth, for example, is the percentage of stock that there is in the market. What is the percentage, or what is the amount of shares that exist in the market. The momentum, like I said, is the acceleration, which is growing. If it's a high momentum, that means that it's growing quickly. If it has a low momentum, it's growing slowly. If it has no momentum, it's not growing at all. Okay. Again, breadth is the percentage of, or the presence of how many shares there are in the market. Then you have chart patterns. Here these are just statistics, resistance, support, trading channels, investment sentiment, the level of bullishness or bearishness in the market. Now, what is bullishness? Bullishness is where the hope, how much do people believe that this is going to, okay, this also affects the market. Okay. If bullishness is high, then that means that there is the hope for this to grow. Whereas the opposite, the bearishness, is where people expect the expectation of failure. Okay, so if the investor has a high bullishness, it has high bullishness in your company, your product or stock, that means that the sensibility of it to grow, or for it to grow, is high. The opposite with bearishness. Okay, if the bearishness is high, that means that you will lose, the idea of failure is high. Okay, so these are things that you need to take into account when you value a stock. Okay, these are things that need to be taken into account when you value a stock. Very good. Now we're going to define some things. This part is going to be definition of terms and what they mean. Okay, for you to take note. These words are typically used in financial or in stock market conversations or activities. So the first thing that we're going to define is tracker fund. The tracker fund is a fund that exactly follows the movement of an index. Okay, so a tracker fund, it's a fund that is constantly, if the index is positive, then they're going to be investing. If the index is negative, they're going to be selling, etc. So it follows the flow. If it goes up, they invest. If it goes down, they sell, and it goes like this. Okay, tracker fund. Capital growth is the regular income of a fund. Okay, so whatever income the fund makes, it's called a capital growth. Okay, then we have the expression junk bond. A junk bond is a low risk corporate bond. We mentioned that what the definition of a bond is, right? It's like a document that it has a certain price. Okay, it's a value. Okay, but it's a low risk. It's low risk. Okay, it's a junk bond. Hedging. Hedging is associated with the risk market. Hedging is the second position in a market. So if the market moves against your first position, your losses are minimized. So it's like you have a second investment in the market. It's not your priority. It's not your your main investment, but you have it like a security. So if the first one loses, at least the second one should be making money. So it's made to minimize your losses. Okay, that's why the expression is called hedging, and it's associated with the risk because um, in case of your first option loses, your second one should make a profit. Okay, it's just to make sure that you don't. It's like the expression that you don't want to bet all your chickens, right? You only bet some, okay, and the rest you keep it just in case. Okay, so this is what hedging means. Okay, so these are 4 definitions. Well, I'm going to define some more. Here we have, what is an investment bank? An investment bank is used by large companies to issue bonds, buy and sell currencies, manage the portfolio of shares in other companies, and advise on any potential merger or acquisition. This is an investment bank. Okay, again, is used by large companies to issue bonds, buy and sell currencies, manage the portfolio of shares in other companies, and advise of any potential merger or acquisition. You know, when one company buys another, like we mentioned in one of our first lectures. Then we have a pension fund. What is a pension fund? Pension fund is it's used to save money during your working life and then have an income during retirement, like what we call here. We have the AFPs, right? That's your pension fund. Okay, or the or the OMPs, you know, the national fund, or the AFPs, which are the private funds. Then we have a mutual fund, which I mentioned before. It's used by private investors to hold a basket of stocks. Okay, so again, it's a group of stocks owned by many people. Insurance company. Insurance companies are used to protect yourself against risks. Money is paid out if something bad happens. Okay, so for example, you can have an insurance on your car, your house, on your life. If something happens, then you get money in exchange. Of course, you have to make a money, and you have to make a monthly payment, depending on what the value of your insurance is. But again, it protects you against risks. Then we have endowment. Endowment is used to generate an income for non-commercial purposes, in particular to run a university or provide for charity. For example, the Bill and Melinda Gates Foundation. Okay, it's like you collect money, but the money is going to be used not to generate income. This money is going to be used to help others normally, okay, or to build something in a university, a hospital, or to help students who don't have enough money, or poor people. So this endowment, okay, is to generate income, but not for commercial purposes. It normally is for humanitarian purposes, or to help other people. It is endowment, okay? It's very common nowadays, especially amongst people who have a lot of money, and that's the moral thing to do, right? If you have more than enough, then why not help those who don't have? Let's continue with some words next. Market capitalization, okay? Now this is the share price multiplied by the total of numbers of issued shares. So this is how much money you have, okay? And it depends on the price of the shares multiplied by the number of the shares that you have. Each share has a price. If let's say each share is valued 5 and you have 20, then that means your market capital is 100, okay? So you multiply the price of the share times the total number of issued shares. Next, earnings growth. Earnings per share compounded over several years, okay? So your earnings growth is how much money that share made you, okay? How much profit that share gave you. And it is compounded over several years. So this is the earnings growth. Next, return on equity. It's how much profit is generated in relation to the money shareholders have invested. Okay, now this is your equity is how much profit you have generated compared to how much you have invested. Okay, so that is your equity. Okay, if you made 1,000 and you invested 800, then your equity will be 200, because that's, I mean, that's the relationship between what you made and what you invested. Next is the PE ratio. Like I mentioned before, it's the current share price compared to its earnings per share. So this is how you know what the ratio is of each share, right? You divide the price versus its divided by its earnings. That's the PE ratio. Next, we have the dividend yield. It's the annual dividends per share divided by the share price. Okay, so now this is similar to equity, but this is annually. Okay, so the dividends that each share made divided by the price. Okay, so the annual dividends divided by the price of the share. It will give you the yield, the dividend yield. Okay, so these are some this is some vocabulary, like I said before, related to financial markets. And now we have this is once more, but let's say, for example, the price level, a price level which has stopped in advance of previous occasions. This is called the resistance. Okay, the price level which has stopped in advance on previous occasions. So again, it's logical. It's all its name says it. Okay, when something is resistant, that means that it's stopped. It doesn't allow advance. You know, it stops, or it makes you advance slower. You know, it doesn't let you go quickly. It doesn't let you advance quickly. Next, a price level which has stopped a decline on previous occasions. This is the support. This is the opposite. Okay. A price level which has stopped. Okay, it was going down, and all of a sudden it helped it stopped you from falling, or it helped you to stop falling. This is the support. A total number of shares traded in a market on a particular day. This is the volume. Okay, like I said, quantity, right? The total number of shares traded in a market on a particular day. This is the volume. Next, a number of individual stocks participating in the movement of an index. This is the breadth, like I said before, right? The number of individual stocks participating in the movement. Like I said before, the number of stocks that are available in the market. Very good. And let's continue. Next, the strength of a trend as measured by speed and length of time. This is momentum. Like I said, acceleration, okay? This is translated into acceleration, the speed. How fast is something going, okay? The strength of a trend as measured by speed and length of time, acceleration. That's momentum. Two parallel lines drawn on a chart that contain all the price movements over a period of time. This is the trading channel, okay? Two parallel lines drawn on a chart that contain all the price movements over a period of time, okay? Going, let's say in a year, in a month, or in 5 years, all the movements of the price, okay? This is the trading channel. Now, a kind of companies that are moving the market, technology companies or utility companies, large capital or small capital, this is the leadership. Okay, these are the ones that set the standard. Okay, they move the market companies. And for example, normally when if a certain company starts to do well, then associate companies or companies related will also continue, will do the same. They will follow in suit. Whether there is new money available to invest in the market, this is liquidity. Okay, do I have money? I mean, do I have not? I mean, if I have a liquidity, that means that there's always new money being put into the market to continue the movement. Okay, so it never runs out. Okay, so this is some definitions that can be used in what financial markets are and how financial markets work. Like I mentioned before, this is business for specific purposes. I'm basically going to give you definitions. I'm going to give you certain terminology for you to know, to learn, and to be able to use. In maybe a couple of weeks, we're going to go back to some general English topics where we will talk about grammar and vocabulary and verbs and whatever. But that is general English. Okay, when we remember that when we practice English for specific purposes, it's basically English related to, in this case, finance. Very well, and this is the end of the topic of our topic will be it's different for next week. So do you have any questions? Do you have anything I can answer? Remember, you can ask me in the chat area, and I will gladly answer your questions. Okay, again, thank you for following these lectures. The English lectures are now Monday, Wednesdays, and Monday, Wednesdays, and Saturdays at 9 in the morning. So if you have any questions related to the topics or in English in general, you can locate me at my email, or my WhatsApp or my LinkedIn account, CJM Flores27. Okay. So I hope you have a great weekend. Enjoy your Saturday, enjoy your Sunday. Please remember that COVID is still out there. Be careful. Don't go out unless if it's necessary. And if you go out, remember to wash your hands, clean your shoes, take all the necessary measures to avoid infecting your loved ones, because we never know how this disease or this virus can affect anybody. Okay, it's totally different than the one. So please be careful. God bless you, and I will see you on Monday. Thank you very much. Bye bye.